All right, good afternoon, folks. Welcome to tonight's presentation featuring Doug Robertson. Doug Robertson has been in the finance industry for well over 18 years and has had a brilliant career. His experience stems from being president of a high-frequency trading operation for a number of years here on Wall Street, where at one point they were trading $500 million per day in Forex trading. Well, needless to say, this man does know his markets. And of course, he wants to share that particular knowledge with you this evening. Before we begin, I just wanted to bring to your attention why we are all here. And of course, that is to identify our specific needs in terms of becoming more knowledgeable and hopefully more profitable while trading options. Doug is going to discuss some tactics this evening on his approach to the options market itself. This is just a small piece of a two-part program that Doug teaches that dives very deep into the power of options and the options world. So tonight's session will focus on more advanced methods, but we will also touch on how you can get the foundation to this session later on in the discussion. But folks, let's just get right to it. Without further ado, here is Doug Robertson.
Hey, how's it going? And she's after that intro, I feel like I need like a little fanfare coming in. Thanks for that. Hey everybody, how's it going? Good to see you again. Glad we have you all showing up. Now, so as Sadie was saying, what we're doing is a couple of things tonight. In fact, we got kind of 2 points tonight. One, we're trying to give some background and some understanding of the program that we've got coming up, which is an educational series. It's actually 2 parts. One is on foundations of options, and the other is on tactics. And I'm going to talk a bit about that. Before we get going, I'm going to dive into a little bit about why this series has actually been developed and why it's been created the way it is. Did want to do one quick thing before I dive in, and I always like to do this just because I'm curious. I always like to do my survey of who's from where around here. I am, where's everybody from? Everybody could just do me a quick favor and just toss into the Q&A box a little thing, and I'd love to see Long Island. Long Island, yes. Greensboro, North Carolina. DC, excellent. I'm always curious to see the furthest person away. Vancouver, okay, you win so far. Toronto? Love Toronto. Good stakes, Ray. Very good stakes. Finland, okay, you are absolutely the furthest away so far. Denver. Excellent. Lubbock, Texas. Okay. Apopka. Apopka, Vineland. Yes. You're not very far away. Spain. All right. We've got people from all over the world tonight. Always good to see that. All right. Before we get going, I have to do a little segment that we jokingly refer to as Appease the Lawyers. So let's take a look at that. T3 Live LLC is not an investment advisory service, nor a registered investment advisor or broker-dealer, and does not purport to tell or suggest which securities or urgencies customers should buy or sell for themselves. The independent contractors and employees or affiliates of the company may hold positions in stocks, options, currencies, or industries discussed here. You understand and acknowledge that there's a very high degree of risk involved in trading securities, options, and/or currencies. The company, the authors, the publisher, and all affiliates of the company assume no responsibility or liability for your trading and investment results. It should not be assumed that the methods, techniques, or indicators presented in these products will be profitable or that they will not result in losses. Past results of any individual trader or trading system published by a company are not indicative of future returns by the trader or system, and they're not indicative of future returns which may be realized by you. In addition, the indicators, strategies, columns, articles, and all of the features of the company's products, the information are provided for informational and educational purposes only and should not be construed as investment advice. So let's see here. What do we have going on? Well, T3 asked me to develop out a new education series. And we had some things that we've done in the past. We wanted to go a bit beyond it. And I've been teaching for a very long time, teaching options, teaching finance for a long time. And so as I thought about this, I wanted to dig down and actually try to nail down some of the core problems that I see with options traders. So I want to cover that a little bit first because it kind of hopefully will help you, and it'll also give you a little bit of a perspective on where we're coming from on this. So we've got two pieces here. So tonight, I want to talk about that a little bit, give you the kind of a little bit of a reality check and some core problems that people have with trading, some ideas on fixing those. And then I also want to relate that to what we're going to be doing for the training program, the fundamentals trading program and the tactics trading program coming up over the next 2 weeks. And to do that, I think the best thing to do is actually show it off. So in the second half of this tonight, we're going to dive into one of the trade tactics that we get into in the actual tactics training class. Coming up, actually, that's the second week of the training series. So I'm going to give you a hands-on example of exactly what I'm talking about and what it means. So before we get into that, as I said, let's dive into some of the things that I generally see as impediments or misconceptions or things stopping people from being successful options traders. Now, and I see this as a progression, by the way. This is kind of waking up of people as they get into the options trading world. They go in with one set of basically misperceptions or misconceptions about what options trading is. And they beat themselves up against a wall. They make mistakes. They lose money. They get very frustrated. And regrettably, some of them leave. And others keep pushing through until finally they figure a couple things out here and there. And then finally, hopefully, we catch up to them and we start to teach them some things that can actually help. So I wanted to try to create something that bypasses that process a little bit. And by the way, before I dive into each of these things, I want to point something out. What I'm about to talk about is not just about brand new people who've never traded options before. I see these same exact problems in people who've been trading options for years and just never really got a formal understanding of it. And it creates painful situations. It creates financial losses. It creates bad decisions. It creates problems. So let's dive in. Let's see here. First of all, problem number one, options are not stocks. Okay, I'm going to literally stand up on a soapbox as I say this in front of the screen. You can't see me, but that's what I'm going to do. Options are not stocks. How many times have you seen somebody or heard somebody talking about, or maybe even you've done, where you've seen a stock trade that you want to take, and people, you jump in and you buy a long call or you buy a long put. You know, you're going up and down, and you're treating the call and the put as if it was a cheap version of stock. Okay. Now, to be fair, there are minor cases when that might work out. There are, opportunities here and there. The problem is that the options market doesn't work like the stock market. It is not a quick little, movement up or down. Options prices move very differently. And what the reality of that situation is this. By doing that, you are setting yourself up to lose. The market makers are pre-pricing in the expected movements, what you expect as a potential movement in a direction, one way or another, that you're trying to take advantage of using that option, that long call or the long put. The market makers have already priced that in, and they're going to make money off of you as you try to do that. This is the equivalent of walking into the casino and starting to push money into those slot machines. You do it over and over and over again. Once in a while you win. Once in a while you come out with a nice profit in your pocket. But over the long run, they don't build those, great big, huge, beautiful casinos off of losing money to people. It's the same situation. The real problem that this actually uncovers is that very few people understand how the options market really works. There's this lack of understanding of what makes it function and what drives the prices and what creates value and what creates opportunities. Because if you knew that, and if you understood that, you wouldn't be making those mistakes. You wouldn't be doing those costly mistakes. That's one of the things that I wanted to try to address with this program. Number two, not thinking in probabilities. Now, this is a little bit of a step for some people. It's really not as hard as you might think. In fact, options make it easy to start thinking this way because they give you the answers right in front of you. But there's a common thing I see. Stock trader comes to me, and they're in one of my groups, and they're talking, and they start talking about a trade, and the first thing I get is, why would I take a trade with a risk to reward ratio of 5 to 1 or 6 to 1 or 2 to 1 or whatever? And it's always they're making this point of the risk being so much bigger than the reward. Why in the world would I ever take that? Would you? And actually, let me toss it out. How many people have thought along those lines? Love to get a little bit of interactions and feedback going here. If you've got some thoughts, put them up in the question box. I see this all the time. Now, it's not a horrible question by itself, but guess what? It's looking at 2/3 of a problem and completely forgetting about one of the fundamental legs of making that trade work for you. It's missing a huge point. In fact, what happens is it's so easy to ignore probability that people end up making fatal mistakes. So let me talk to you about how that fatal mistake happens. People think that a 5 to 1 risk to reward ratio, I'm risking $5 to make $1, is such a bad idea. So then they do this. They want to change the trade to make it to a 1 to 1 risk to reward. I'm winning 1 and I'm risking 1. Or maybe even more, I'm going to be able to win 2 and risk 1. What they're ignoring and what they don't see is that every time you do that in the options market, you're changing the probability of you being successful. And a lot of times what you've just done is you've made the trade such a high probability trade for a loss that not only are you going to likely lose most of the time doing that, but you're going to be struggling with slippage, you're going to be struggling with extra commissions, you're going to be struggling with all kinds of these costs, and it's eventually going to kill your trading. You have to understand that a big part of trading options is understanding probabilities, is understanding that a 5 to 1 ratio trade can be an outstanding trade as long as it has the right probability of success. If I can set myself up a 5 to 1 ratio trade where I've got a 90% chance of success, then heck yeah, I will take those all day long. And I want to take those. You should take those. Even less of a probability, you can still get a very, very nice edge. You can get a nice advantage in the market by doing that. But you have to understand how the whole probabilities and odds work. And when I see people come in, this is such a common point of pain for people where they're literally sitting there thinking that they should be doing better and they're not. And it drives me, it's almost painful for me to watch because I see the same problem over and over again. They think that one thing changes the world so much that they chase after it in the wrong way and they create a worse outcome for themselves. Not understanding volatility. Yeah, James, you're right. Having a trade with a risk reward increases the probability for profit greatly. And that's the thing. Actually, James, I'm going to touch on that one more time. You know what it really does? You know what taking and shifting that risk to reward ratio a bit, maybe towards, maybe so it looks more like the risk side. Once you put the probability in there, you can do something with options you just can't do with stocks. I can't change the odds of a stock moving in the direction I want it to go in. It's hard. It's almost impossible to do. But I can radically change the probability of an options trade being successful. And because of that, I can do something really powerful. I can change the way my overall big picture results work. Now, I can take high risk, very low probability trades, and every once in a while I swing for the fence, I knock it out of the park, and I make a bunch of money. Great. My portfolio goes up. I just made a bunch of money, run down to the bar, brag to all my friends, I'm cool. Excellent. Well, guess what? By doing that, you're also exposing yourself to a massive amount of risk. And quickly as you made it, something comes along, knocks it out of your hands, and you're now back down. The variability of your portfolio, the whipsaws up and down, kill you. Remember, every time you get knocked down, it's much harder to get back up. You don't deal with that the same way in options. It's a totally different world. We adjust it so that the probabilities are actually highly in our favor. Now, we might not be swinging for home runs, but I'll take 15, 20% returns over a 30-day period with an 85, 90% probability all day long, and I'll take those consistently time after time after time, and I will generate profits that are solid, consistent, and predictable. And I don't have to deal with these whipsaws in my portfolio. So think about that. Would you rather have consistent results with good, solid, reasonable trades that give you a good, healthy profit, nothing to be ashamed of at all, or do you want to have the ability to run down and brag to your friends that you made a big trade? I personally like to have money in my portfolio. That's what I like. Not understanding volatility. This is another core problem. And it is a real problem because the majority of an option's price is based on implied volatility. And that's just flat out the reality. Most of the price of an option is made up of basically a representation of three things: fear, uncertainty, and doubt. Okay? Now, a little bit of greed mixed in there too. A certain portion of it is definitely greed, but the price of an option is driven by these things. What is the risk? What is my fear that the stock is going to move through this strike price? What is my fear that this big gap could happen? What is the risk around all of these things? And that is basically brought together in the market and there's a price put on it. And that is what drives the options price. Now, would you trade something by ignoring the majority of its price? Would you trade something by basically ignoring what creates the price in the first place and focus on something else? I kind of feel like this is like Plato's cave or something. We're trying to trade based off of the shadows in the wall. You're not looking at it. You're not seeing it. Worse yet, you're not seeing the opportunities and the risks that are there. And there are real opportunities, big opportunities, and big risks that you can find and identify quickly and easily just by understanding about how volatility works. So that's one of the things that I feel is an important thing for people to understand. Fundamentals do matter. You have to understand how these work. They're not hard to learn. It's not something that's, this subject that nobody can get. It just takes a little time, a little focus on the problem, we work through it, and you get it. Once you do, suddenly you start seeing a lot more things. There's new opportunities all over the place. In fact, I would say nearly 80% of my opportunities are driven in some way or another by understanding how volatility works above and beyond just the simple, where's the stock going? So the big part, we want to fix that problem. Last one, and this is always a never-ending challenge. Where do I find trades? How do I find trades? How do I do this? Well, there are a ton of trades. First thing that you have to know is where to find them. It's the undiscovered country of options trading. People go into options trading thinking that they're basically going to use the same approach and same tactics and same knowledge that they had for stock trading or other trading. And all of those things are absolutely wonderfully valuable. Not going to say that they aren't going to be useful. But what happens is you end up focusing on a specific category of trades, mainly focused around whether or not a stock's going to move up or down. And that means that you end up using a certain style of trades and you get stuck with one thing. Now, you don't know how many times I've come across a person who's basically a vertical spreads trader. Bull puts, bear calls. Now, I give him credit because vertical spreads is a nice step up from just buying that long call and buying that long put. And that's definitely a good step in the right direction. Maybe they throw a few iron condors and income trades in there. But what they're doing is they're creating this portfolio of trades, and they don't realize this part of it. They're creating this portfolio of trades that have a built-in inherent risk to when the market goes nasty, when the market goes into a correction, that it blows up on them and causes them to lose a bunch of money. Now, we can adjust that. There's little things that we can do even within those trades to make them better. But the better thing to do is understand how to find all the trades in the market. Instead of just looking at 20% of the possible trades, let's find all of them. And by doing that, let's take the next step and use the trades together to create a portfolio that's stable and profitable and in control. And it doesn't have to worry as much about the big corrections. I mean, right now, everybody I talk to is worried about when is the next correction coming. I mean, we haven't had, just realize this, we have not had any form of a correction for over a year now. We had, I guess you could kind of call the Brexit thing a correction. I call it more of a shock. It's sitting out there, it's waiting. At some point it's going to come along. And you have a choice. You can have a bunch of trades which are focused on this particular trading style. Creates a lot of, let's say, bull puts, bear calls. You're short volatility. Suddenly along the comes the correction, and boom, everything blows up, and you're sitting there wondering, why are all these trades doing so poorly? Or we can build the portfolio off of a broader selection of trades because we understand different tactics. We understand different trades that are going to give us a different advantage, and we can create a portfolio that actually weathers that storm very well. I'll get into that a bit more in a second. Yeah, it should really say that most of an option's, extrinsic value, but actually, John, if you want to get picky about it, if you sum up all of the values in the options market, more than 2/3 of the value of the options market is in implied volatility, flat out, across the board. That's if you just sum it up across everything. Because remember, half of every option series is out of the money, and that's all IB. Let's see. Doug, do I typically defend a credit spread that goes against you, or do you buy it back at a certain amount of money? Right, I'm going to do this real quick, but I want to give you a little something to think about on that, and then we're going to jump into the next slide. Whenever you have a trade that goes bad, I want you to fundamentally think about this. Whenever you have a trade that goes bad, you have just been proven that whatever you thought about that trade was wrong. I'm not saying that to be a jerk, just saying it to be real. This is, and by the way, I think this is another one of those fundamental core problems that people have. And I feel a little bad about this one because I think that this has been sold to people a lot. And it's been sold, the idea has been sold incorrectly. Whenever you're in a trade that goes bad, you know what just happened? The market proved to you, flat out proved to you, that some assumption that you had about that trade was wrong. Okay, that's it. Flat out. We were wrong. I was wrong about taking this trade. Now, that's part of the game. I'm wrong quite a bit. I try to not be wrong too much, but I am wrong quite a bit. So, whenever you've got a situation like that, you've got two choices. One, we use a correction strategy, a repair strategy, a Mr. Fix-It strategy. And we rush in and we basically fix the trade. Or two, we close it and we walk away. Now, what's the smarter of the two things? Well, the reality is when you fix a trade, you're not fixing a trade. You're blocking in loss and you're replacing it with a brand new trade. So we're now taking a brand new trade on a symbol that just proved to me I didn't know what I was doing on it, in the hope that I'm going to make some money back. Wouldn't it be a better thing to do to take that money, go someplace else in the market where I'm not wrapped up in that trade, where my head isn't, saying I wish I won or I want this to win, where my, opinion isn't clouded, and put that money to work someplace that I can clearly assess the situation and make a clear, emotion-free judgment call and make my money back? That, to me, is a far smarter move. So, no, I don't do repair strategies. I do a lot of management of the risks. That's absolutely part of the plan on every trade. But I want to always be finding the place to use my money to make the money the best way I possibly can. So, there we go. Okay, let's take a look. Here's the big problem that I see. And by the way, all of these things, including that little side trip that we just got on, Fred, it's a good question. And by the way, I did expand your question a little bit into repair strategies and things like that. But you do want to manage your trades. You do want to have a good, clear head on what makes you the most money and what takes the risk off the table. And all of those things apply to this. But here, let me see if I can wrap everything up. And this is really why the theme behind the education series that we've got coming up. Learning options trades piecemeal, and this is what I see a lot of people do. This doesn't make you a good trader. You lose the idea, the big picture of what is making options work. Now, I'm not saying that a person can't get there. I'm not saying that you can't, over the years, build up a broad base of knowledge and experience that gets you to the point of being a good options trader, a real good fundamental options trader that can do a variety of different things. They can manage their portfolio well. They can balance things out so you don't have risks. Create a controlled situation so that you've got good opportunity for making money while minimizing your risks. It's not saying you can't get there, but it takes a lot of time and it takes a lot of effort, and it's a lot of holes that you end up in your knowledge and understanding when you're picking things up piecemeal. And let me just give you an example of this. It's not uncommon for me to see somebody put out a training class and teach you the 5 fundamental tricks to trading iron condors. My system for making money with bull put spreads, bear call spreads, all of these things. What they're teaching you is an individual tactic from a single point of view. Now, they might be great people with wonderful intentions, and they might have some good information, but they're not showing you the big picture. And I found that once people get the big picture, they understand the options trading a lot better. In fact, what I'm going to show you tonight on a trade, I hope actually illustrates that point. It actually shows you how the bigger picture gives you the ability to see trades that you would never even see before, and gives you the ability to literally open up the world to a whole different series of different trades and strategies and ways of making money. There's always opportunities to make money in the options market. In fact, there's way more opportunities in the options market than I would say there are in the stock market or a lot of other markets. But you have to be able to understand them and see them. So, here's the basics. The solution to the problem is actually just being a balanced, well-educated trader with the tools you need to make it all work. You need the options foundation, the fundamental understanding. Why does the options market work? How do the prices happen? How do all these things fit together, and how does that help me make money? Because if you don't know that, you're just following a checklist and hoping it works. Second part, trade tactics. And that's actually what we're going to be diving into tonight. This is going to be a little sample of the tactics classes that we're going to be doing as part of the upcoming tactics lab. Tactics are the tools you use to make opportunities turn into a profit. So this is, I guess the analogy on this one is the plumber. A plumber does not go to a person's house to fix a problem or to solve something with one wrench in their bag. That would just be absurd, because they don't know what they're going to get when they get there. They don't know what they're going to see. They need to be able to take a look at what's going on and use the appropriate tool to make it all work better. Same thing with us. It's nothing, we're not anything special. What we need is the tools to do the job correctly. So that's one of the things that we get into during the tactics series, is showing you a wide variety of different tools, but not just the individual trades themselves, also how they fit together and how they can be used. This trade over here offsets the risk in this trade over here. By putting these two in your portfolio, not only do we have 2 trades that each individually have a good reason to exist and can make money, but if crazy things happen, the next correction comes along, one trade balances off the risk of the other trade to make it so that you lose less money. I'm still getting the opportunity for the profit, and overall my portfolio is more in control and loses less. And the final piece that pulls it all together is what I like to refer to as a portfolio trading system. This is actually a way of looking at trades that basically people seem to ignore a lot. I'm not saying completely. I think that a lot of people understand it in the back of their heads, but they don't trade this way. I see so many people who focus on a trade. I have to win this trade. The point of the whole trading process is not to win this trade. I am not sitting here trying to conquer Priceline. I am not having a moral victory over Chipotle Mexican Grill. I am trying to have more money in my portfolio at the end of the month than I have at the beginning of the month. That is my goal, my simple, straightforward goal. So why do people get so wrapped up in trying to make one specific trade work while ignoring the things that would basically make the entire portfolio work better? In fact, bluntly, there are times when you can put as much effort as you want into making a trade work, and the more effort you put in doesn't do you any good, doesn't get you any more advantage. You still have the opportunity, the possibility that the market's going to come along, change, and that trade's going to fail. Let's build a portfolio of trades that allows that to happen. We don't have to freak out or worry about that happening. And I'm not saying you're not going to lose money, but if I had a choice, if I was sitting there and the market correction happened, and I have a portfolio of trades, and I could have been one of two people. One person was the one who was so focused on the trades they forgot the big picture. They didn't build out a portfolio that worked well. They didn't build out something, a system, a process that was a safe, controlled process. And they lose 10, 15% of their portfolio. And I hope they don't lose more. Or I could be the person who did understand that with a little bit extra effort and a little different focus, I can actually fit these things together like a puzzle. Add a little bit of volatility over here, a little bit of bullish direction over here, a little bearish direction over here. And as I blend them together, I can be aware of how it all works. And the next trade I pick helps bring it back into balance a little bit more. And I'm going to be the person who loses 2 to 3%, while that person loses 10 to 15. And while they're fighting to get their portfolio back up, I'm back making profits. And that's where I want to be. So, what are we going to do on this one? The two courses, it's actually one broader big picture course broken into two segments so that people can take the piece that fits them the most. Ideally, my thought is that you should probably take both. You should actually take the fundamentals class for the first week and then also dive into the tactics. But we start out with the concept of fundamental knowledge. What makes the options market work? What determines the options price? How to use that to create an advantage? Identify real trading opportunities in all different types of markets, finding and using an edge. Now, this is an important thing. Just knowing how things work doesn't always give you the answer. You also have to figure out whether or not that situation is giving you an additional edge, giving you basically a chance to make money over the long run. And then an understanding and the tools to engineer the trade to give you the maximum reward. So this is the power of options that a lot of people miss. They have this checklist that they do. I'm going to do this strike, and I do this, and there's my trade. There's a totally different perspective on it that gives you a lot more power. And that's a trade engineering perspective. And it's literally just like engineering. I've got this input and this output, and I'm going to tweak these things until I get what I want. I have the possibility for amplifying my profits. I can trade that off against different risks. The best thing that you can do is you can actually adjust the way the trade works so that you give up something you don't care about, maybe the reaction, the way the trade works over time, to get something that you do care about, the ability to make a lot more money as the stock price moves up. Whatever. There's a lot of different variations of that. But when you approach it from that point of view, you get a lot more power and control over your trades. You end up creating situations that make you more money and control the risks in a better way. Second one, and this is what we're going to dive into tonight. Expand your toolkit. I'm a bit of a tool junkie myself. I've got a garage completely full of power tools and love doing woodworking and things like that. Helps to get me away from the computer. Tools allow me to get results. In this case, in options trading, knowing a wide variety of tools, more than just one or two styles of trades, allows you to take trades that maximize your profit and opportunity at that time. Is a bull put spread, a basic vertical spread, the best way to actually make money on this stock going up? Well, in some cases, yes. Other cases, absolutely no. We're still doing the same thing, but how do you maximize the potential for making money and minimize the risk? Well, to do that, you need a different set of tools. And that's where we dive into calendar spreads and figure out how a directional calendar spread can actually maximize the profitability of that trade in certain situations. And also how that all fits into your portfolio and makes everything work better. Know where to look and find new opportunities, different trades to maximize your profit potential, and build it out into a real option trading portfolio. I like to encourage people to stop thinking about trades and think about their portfolio of trades. Our goal isn't to win a trade. Our goal is to create a process and a system that works all together to generate profits. And that's what we're going to work towards. That's what we're going to build out in this program for you. Finally, bringing it all together and creating that portfolio trading process. The ideas in this are actually really common in professional trading firms. This is the types of things that we used to look at all the time. And it boils down to this. I can put it really simply. If I have a trade that's a good idea and it makes money by by this stock going up, if the market goes up, it's going to help that trade make money faster. But if the market suddenly goes down and drags that symbol with it, it's going to hurt it. If I combine that with a second trade that makes money from the stock going down, the individual symbol going down. Now remember, stock prices and these trades are going all in their own directions at different times. You can always find something that's bearish and something that's bullish. And this is a very simple concept so far. If I have that second trade that makes money when the stock goes down, and that profit gets amplified when the market goes down, and I combine it with the first trade, I create something special. I create something that's actually fairly powerful. Taking away risk in most portfolios is an expensive proposition. Anytime you hear somebody say hedging off a portfolio in terms of just buying insurance and using options to do that, that is expensive. You're giving up a lot of your profits to make that happen. But if you can balance your portfolio, create a portfolio of diversified trades, and I'm going to take it beyond just the idea of bullish or bearish. We've got volatility to take into account. We've got time erosion to take into account. If we build all this stuff out and we balance these things out, we can create a portfolio that, not saying you're not going to lose any money, but when things go bad, instead of losing a lot of money, you lose a very minor amount of money in a way that's controllable and manageable, and you don't have to stress about it. By putting this all together and creating that process, you're creating a way for you to consistently make money. And that's what we want to get to. That's the results we want to have, is that way of making profits. So that's what we want to get to. Now, that's all well and good. And good stuff to talk about. But we need to know that this actually works. We need to know that these opportunities are out there, and I don't expect you to take my word on this. I enjoy teaching, talk to anybody in my classes and they'll tell you that, but I expect you to make smart decisions. So what we brought in tonight is the chance to take a look at one of the types of trades that I actually actively do on a regular basis. As a matter of fact, the trade that I'm going to dive into right now specifically gets into a number of the points that we talked about this evening, about the different pain points, the problems, the core issues that you've got there. And hopefully I can show you how a little bit of a different view of things can open up a whole bunch of different trades. Now, I want to be clear. We're going to go through this relatively quick. I'm going to try to be clear on the points, make sure everybody understands that, but the idea is to show how this all works and how this piece, this sample of the class is going to go. When we do the class, when we're doing the lab, we go into far deeper depth. We don't do it quick. We take our time, we work through the problems, we understand it very, very clearly by the time we're done. And then what I'd also encourage everybody to do is be involved in my Options Strategist program, which is a weekly group that gets together. We're actively trading, and we actually put those trades to use in the live market. We're putting them basically out into the market and following them and managing them as real trades so that you get a hands-on experience doing these. You don't learn to drive a car from a book. You learn to drive a car by driving a car. We take the knowledge and we put it into play. So tonight, I'm going to dip into a little bit of the Thursday session that we're going to see in, not next week, but 2 weeks, which is fear, uncertainty, and doubt for profits. And this is basically playing with volatility as a trade. Right now, this is a great time. I'm jokingly referring to 2017 as the fear, uncertainty, and doubt trade of the year. I'm not sure that we've ever had a point in time when there's more fear, uncertainty, and doubt floating around. And this creates immense amounts of opportunity. So let's poke around with that, actually play with some of this stuff. All right, what do I mean by fear, uncertainty, and doubt? All right, I like to term it that way because it kind of puts in your head a little bit of an idea of what really is going on. So let's take a little step back and talk fundamentals of how the heck options prices work. And let's go from there, from the fundamental idea, and then build out a trade. So when options prices go out with the market, when they're floating around, every option has a strike price. And there are market makers and floor brokers and professional trading firms who are trading those options. And a big part of what they do is sell those options. Now, this is the equivalent of selling insurance. Literally, it's the equivalent of selling insurance. Now, as they're doing this, they're looking at what is the risk that the stock is going to quickly move up or quickly move down, causing them a loss on that insurance policy, the option, that they just sold somebody. Now, these people are well-trained, well-educated, understand the markets from a very deep level, and they are not going to put out trades that basically are not paying them enough to take a risk. So now what happens is, as the risks in the market increase, maybe there's something going on that might move a stock around. There's a higher chance that the stock might jump up suddenly or collapse, gap down. As they see those risks out there increasing, what's happening is they're raising the price of the options. Now, on the flip side of that, you have to have buyers to have any market work. And a big portion of the buyers out in the market are the long-short hedge funds. These are professionals. And they have a goal that's very, very different from you and I. They have a very specific target they're trying to hit. They want to use that long-short idea, mixing bullish trades, stock trades mostly, bearish stock trades, with a portfolio view that lets them balance it off. This portfolio strategy we're talking about. It's what they use. This is what they do. And their goal is to get less of a return than the market is giving them, than the market is having. So if the S&P 500 goes up 10%, they're targeting an 8% return. This is why you hear a lot of little reports that are completely stupid, to be honest, that say, on average, hedge funds make less money than the market. Well, yeah, they're actually targeting that, and there's a reason they're targeting that. Because what they're doing is they're setting up a portfolio that's making 80% of the profits of the broad market while taking half the risk. Now, you start to mix the risk and reward in there, and that actually works out pretty good. And they sell this as a service to Harvard Pension Fund, the Yale Foundation, CalPERS, all of these things. The Saudis, the Saudi Sovereign Wealth Fund, big buyer of this stuff. They know that they're going to lose customers if they fall outside the risk band. So what they do, they go out and they buy options. Every time that risks go up, you see those guys jump out and they're buying options to basically lock in and protect their portfolios against big moves. That's also driving implied volatility and the price of options up. Now, efficient market theory aside, let's talk about what really happens out there. Options traders, floor brokers, market makers, they don't do this as a charity. It's not what they do. And I know these guys. They're friends of mine. They have nice houses. They have great cars. They have the cabin down on Lake Michigan. They have blah, 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 all of this different stuff. And they have a wife and children or, or a husband or whatever. and they have a life to pay for. So they're not going to just put the price of these options out there at what they believe the real risk is. They're using the need for these long-short hedge funds to buy these things, to pump up the price, and to create an advantage for themselves, to build in an edge, because they need to make money. Well, I need to make money too. So there's the fundamental idea. You can actually spot this. I mean, I can point it out, a little bit of a analysis of the way a stock actually moves, its historical volatility versus its implied volatility, and you can spot it a mile away. There's a point in time, though, where this becomes very, very specific. Earnings announcements. Earnings announcements are great. They're this point in time where we know that something amazingly risky is going to happen. We know that a company is going to release a ton of information about its operations, its finances. Am I doing good? Am I doing bad? And normally it's when the markets are closed and that stock can gap up, it can gap down. There's all kinds of things. So what do the market makers do? As they get closer and closer to that moment in time, that earnings announcement, implied volatility is going up. It's going up a lot. I mean, a real lot. So how do we use this? Well, we understand how it's going to happen. We can see it in the market, and we basically build trades around it to join in on the same side as the market makers. We become part of the process with them and basically set ourselves up for a good profit based on that. And that's where we're going. Now, one of the reasons I like this trade, one of the reasons why I really feel like this is an important piece to have in my portfolio, and bluntly, it's one of the biggest generators of profit that I've had for the last several years as a piece of my portfolio, is this. Stock prices are hard to predict. They're just hard, all right? If you ask me exactly where is Chipotle Mexican Grill's stock price going to be in 30 days, I would have a seriously hard time telling you with any level of confidence. Stock price could go up, stock price could go down. Now, some people are great at picking that out, but even those people are not perfect. On the other hand, implied volatility is not hard to predict. In fact, it's extremely consistent. And I put up Chipotle just to make the point on this. You see this little chart down here? See this green line, kind of in the field of dots and stuff? Excuse that. That's an indicator that I use with my class that we built out to figure out some different things about the options market. But the point I want to show you is this. You notice how this line goes up, peaks out, collapses. Up, peaks out, collapses. This is practically a heartbeat. Boom, 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 boom. It is a predictable, consistent feature of the market, and it happens over and over and over again. Knowing how and why that happens, we can set up trades to take advantage of it. All right, so let's dig in and do that. This is a trade that I actually took today. This is live right now, so we can't do a live trade after the market's closed, but I did take this one earlier. Price line. So what's going on here? Price line has an earnings announcement. It is actually going on, well, it says 216. Now, I want to point something out. You learn pretty quick that a lot of the brokerages have really bad data when it comes to earnings announcements. You want to dig into this. There's a way to check that to figure out whether or not the market actually believes that that's correct. What we've got is an earnings announcement that's coming up in roughly 3 to 4 weeks. We're going to create a trade that takes advantage of that. I know that options that are still in existence or expire after the earnings announcement are going to go up in value because implied volatility is going to increase in those. The people selling them have to do that to protect themselves. I also know something else, that options that expire before the earnings announcement aren't going to go up in value that way. So now we can do a neat little trick and play those two things off against each other. I want to show you something really fast to point out what I mean about differences in implied volatility, and it's not small. Here's JP Morgan. They have an earnings announcement tomorrow morning before the market opens. Now, oops, JP Morgan. So, the options that expire tomorrow, Friday, JP Morgan normally doesn't have a whole lot of implied volatility on their options. Right now, their implied volatility is 42% on the options that expire tomorrow. But the options that expire in just a couple of weeks, actually the options that expire next week, only have an implied volatility of 26%. That right there is a huge opportunity for making money. If you don't know how the options work, you're not going to see it. You're not going to understand how to play this to make the money. But it's not that hard. Getting back to Priceline, let's take a look at this. I'm going to just do this quick. We have an earnings announcement that is going to happen after the 3rd of February. And if I take a look here inside the implied volatilities, I see 19%, 20%, 23%. Okay, guess what? This little gap between this and this means that the options market right now is starting to price in risk on the 17th of February, which means it believes that the earnings announcement is going to happen between here and here. I can literally see where the earnings announcement is going to happen just by the implied volatility changes. So what am I going to do? I'm going to do a very simple trade. I'm going to do a call and a put, basically long strangle. In this case, I'm going to use a little trick, and I'm going to basically frame those around a 1 standard deviation range. So I use a little trick, figured out where my strikes were going to be, and I'm going to buy long a 1465 put and a 1580 call. Now, those two are going to cost me a bunch of money. It's an expensive trade. It's a long strangle. It erodes a lot, data erosion. There's a lot of bad things about it, but there's a really, really great thing. It gives me a lot of exposure to those two options going up in value as implied volatility goes up. Now, I can't just take this. It's too bad in too many ways. So I use that little trick. I go back before the earnings announcement is going to happen, and I sell short the same strikes. Same thing. 1580 strike, I sell the call short. 1465, I sell the put short. Now, what I've done is I got rid of all the problems here. I reduced the cost. I've dramatically reduced the cost of the trade. I got rid of the problem of theta erosion hurting our long calls. I did all of this. Now, normally, if this was just a regular trade with no earnings announcement there, if implied volatility went up, it would hurt my short options, but not in this case. Implied volatility goes up, it only affects the options expiring after the earnings, and it doesn't affect my short options before them. So I get all the benefit of the long options and don't have the problems of the short. Now, let's take a look at the trade. And this thing's going to be great. Hold on. Okay. What's going on here? That doesn't look like a good trade at all. In fact, if you quickly look at this, you're pretty much going to come to the conclusion that there's no way in heck you would ever take this. Well, that's where you're wrong. That right there is where there's a huge amount of opportunity and you're not seeing it. So let me show you how to see it. You have to understand that the trade itself is being driven by implied volatility a lot. Now, I've already done this work, so I can jump back in time and do, kind of understand what things are going to go, what's going to happen. There's this little technique we use, a tool called Think Back, and I basically set up the same trade, but I do it on previous earnings announcements. And I look at what the implied volatility of each of those earnings announcements was at the point I would be exiting this trade. And it gives me a direct example of exactly what happened time and time and time again in the past in the same exact situation as I'm in right now. Now, let me show you what is missing from this. By the way, that is the trade right there. These two options, they're currently at about 22-23% implied volatility. That's not what the implied volatility is going to be when this trade's done. You need to know where that's going. So I went back. There was a November 7th earnings announcement, and guess what? The implied volatility on that was about 55% on the same set of options that I'll be having at the end of this trade. I went back to, let me see, August 4th, which was another earnings announcement. Implied volatility is 59%. I went back to May 4th. Implied volatility was 58%. I skipped the February's because we were in the middle of a correction. That was just a weird period of time. Went back to November again. Guess what we hit? 54%. There's a very, very distinct pattern. Very consistent, very regular, very predictable. All I have to do is figure out what would happen to this trade right here if these two options went to 54%. Now, I am going to actually be super, super conservative on this. And I am going to just change them by about 20% implied volatility, adding 20 percentage points. This is not even close to 54% or 55%. This is way short of that. Watch what happens to the trade. February 17th. There. Now, let's take a little better look at that. That just radically changed things. I now have a trade that I'm risking about $5,000 in, that I have the potential for making over 100% return, have an extremely wide area over which this trade works. By the way, my break-even points on this are all the way down at about 1,400 and up to about 1,660. So as long as Priceline in the next 3 weeks stays between 1,400 and 1,660, I have a pretty darn good chance of walking away with a nice high level of profit. Now, I just made it simple. I just put out a nice 50% profit target, put a limit order out, and I'm going to wait for this to move into it. We're going to put in, we put in risk management. We build out a plan for how we're going to handle this in case something fails. How are we going to make this, how are we going to turn this into our advantage? How are we going to limit risks, control things? But this right here is a huge possibility, a huge potential trade to make money for us that comes entirely out of understanding some of the fundamental aspects of how the options market works. You wouldn't see this before. You wouldn't even know that it's there. In fact, you could set it up, and unless you knew the basics of modeling and figuring out that implied volatility change, you wouldn't get it. It's 100% return potential in this. In fact, more. We got lucky. Let's not get too overly optimistic. We've got almost a $7,000 return on, I believe, a $5,400 trade. I can live with that. That is a good trade. The cool thing is that about the time that we get done this trade. Oh, by the way, I want to make a point about this trade. This trade doesn't even exist when the earnings announcement comes out. This trade right here, I am done, gone, taken my profit, left the house, headed down to the bar and had a beer, days, almost a week before the earnings announcement ever even happens. I'm not actually making my money from the earnings announcement. I'm making my money on this trade from the fear, uncertainty, and doubt around the earnings announcement and knowing how that's going to drive the volatility. So, after I've gone down to the pub, had my beer, bragged to my friends about my trade, come back, get to work again. You know what's really cool about this? Is we have just traded this implied volatility going up. And I wish I had a better way of showing this off. We've just traded this line right here, which is about to happen right here. We've closed the trade before the earnings announcement. We wait a couple of days, we turn around, and we flip the trade around, and we make money as it goes back down. And I was hoping to get one of those on JP Morgan or Bank of America tonight, but it didn't quite work. But next week, we have a whole series of these. Now, this is just one of the trades that we go over and dive into in the tactics course. This is one of the ways that we make money, and it's one of the tools we use to build out this broad portfolio of different trades that allows us to create a system of making money. This trade by itself, by the way, I've got a little tool that I use on this. This trade by itself has a huge number of possibilities. This is a little spreadsheet that I built. It goes out and it basically grabs a bunch of data off the internet, brings it in, does a bunch of analysis on it, and it clumps it up and it lists out all of the targets for these particular types of trades coming up in the future. This is the chart right here you should pay attention to. Count of days until, all right, I'm probably not making the clearest thing here, but count of days until we have an opportunity to do this type of trade or this earnings trade. You'll notice this. This is, this week we have a couple. Going into next week, we've got, let's see, 14 on this day. We've got 15 or 6 on this day. We've got 13 here. We are coming right into earnings season. This is coming right around the corner, and we have an entire wave of these trades coming at us. They're coming at us strong, and there's a huge amount of opportunities. Last quarter, we kicked butt on these things. oh my God, I can't even remember how many we did. And out of no less than about 10 to 15 of this style of trade, we lost once. And a lot of these were 30, 40% returns on the earnings trades, the drop in implied volatility trades. We made those literally overnight. Had a couple that were even bigger than that. And we've got this lined up to come at us right again. And by the way, this spreadsheet is something that when you're part of my group, I share all my tools, the indicators, the spreadsheets, everything right there. I give them to you so you can do the exact same thing. So this is what I want to get people ready for. I want to teach people how to do and get into the deep details. So what I'm hoping, what I'd really like to see, is some of you join me next week for the fundamentals, and then join me the week after that for the tactics class, and learn the process, learn and understand how all this stuff works, and get a better handle, build up a better edge in your trades, and start making more money. That's basically the basic point. Let's work at making more money. So, Sammy, I have basically gotten to the end of what I wanted to say. I will switch it over to you if you want. John, good question. 2-week period between the long and short options due to the uncertainty of the earnings date. Yeah, what we did is we checked a couple of good quality sources for the earnings date, and we got conflicting information. So we just changed the trade slightly. We shifted it so that it had a 2-week period, and as long as the earnings date lands between those two dates, over that 2-week period, we're in good shape. We actually ended up modeling it out off of different possibilities. What would happen if it was the later date, what would happen if it was the earlier date, and both trades came out extremely strong. So it was a really good opportunity. And by the way, we got a nice little boost on this one today. The market dipping was great. That drove implied volatility in the short-term options up a bit. It created a situation where I could actually make more of a credit off of my short-term options and offset more of the cost of the long terms, and actually give us a really, really nice little bonus in that trade. So it was a good setup. I like seeing that happen. Joe, what happened to Goldman Sachs, or actually it wasn't Goldman Sachs. I looked at JP Morgan, Wells Fargo, and Bank of America. When we cover the trades and we analyze them, we're looking for certain things. A certain amount of profitability, a certain edge in the trade, the advantage you're getting over the market. And bluntly, those trades just didn't add up to give us enough of that edge. You don't just take these trades. You analyze them and figure out whether they're a good trade or a bad trade. And there's a couple steps we go through. One of the biggest is just making sure that in the middle of it's kind of a saddle. In the middle of the saddle, you want to make sure that you've got at least a decent advantage of about 10 to 15%. Yep, there we go. And if you do that, you can pretty quickly see what's a good trade and what's a bad trade. In fact, I think the biggest thing to know on this is not so much how to do the trade. It's easy to learn how to do the trade. It's how to pick out the ones not to take. And you just clear out all of the ones that don't give you an advantage. Once you figure that piece out, what's happening is you're taking less trades and making more profit. Understanding probabilities again, exactly, and understanding where your edge is coming from. Bluntly, you know what we're doing here? Is we're riding on the back of the market makers, the floor brokers, the options trading firms that are jacking up the implied volatility and taking advantage of those people who desperately need to buy options to protect their long-short portfolios. They create this imbalance over short periods of time. And we're using that to get a big edge and get out, basically create a trade that gives us a big advantage overall. So what do I call that trade? The basic trade that we're using is roughly called a dual calendar, but there's a lot more to it. It's not what you would consider your run-of-the-mill dual calendar. The structure is, but making it work, you have to look at it in a slightly different way, because it doesn't, considering the way that the volatilities work on different expirations, it doesn't do the same thing that a normal dual calendar would do. But if you looked it up, it would be basically a dual calendar structure. All right, Sammy, you out there?
I apologize for that. Yes, I am.
I'm going to slap you. You're not supposed to apologize anymore.
No, all right.
All right. Well, hey everybody. I have had fun with this tonight. This is a subject that I really love. I enjoy doing. Um, Before we dive into it, I would really strongly encourage you to join me for the class. I think it's one thing I can say is that I've done this a long time, and I can make sure that what you walk away from that class with is way more valuable than the class costs. We will pay for this. So I'm going to hand it over to Sammy. He's a good man. He knows what's going on here, and he can help you through on that part of things. Sammy, thank you very much.
Thank you, Doug. Appreciate it. All right, so folks, I hope you're enjoying this particular session here. I know there's a lot of informative things that are happening. Just give me one moment while I get my screen up. All right, can everybody see my screen?
And definitely, Rob, I'll see you next week.
All right, perfect. So I just wanted to make you folks aware that anything that you've learned here, anything that you've seen here was just a very small tipping point of what's included in just the second part of a two-part training program that Doug does teach. So I really wanted to break this down for you day by day so you can understand exactly how you benefit from entering into a lab like this. So basically, it's broken up into 4 days, as you can see, starting on January 23rd through the 26th. It's done after market hours, so it is convenient for anyone that is trading. This way you don't have all of the fuss of the live market interrupting you and distracting you. So from 4 p.m. to 6:30 for the week, it's about 10 hours in total. It'll probably be a little bit longer because Doug is very thorough with what he does. So let's jump right into the agenda. So day one is directional trading. This particular day will help you understand and teach you the fundamental trades for making money from price movement. That's actually where much of our trading is focused on, is through price movement. So in day one, you'll learn how these options trades work and what tactics are best and in which situations they are best in. Day two is focused on income strategies. Income strategies will teach you how to use options to make profit even when there's absolutely nothing happening in the markets. So Doug will actually help you formulate a sound knowledge to create income with options as part of your portfolio. Day three will cover volatility. And of course, we spoke a lot about implied volatility over this particular session. So predicting where price is going is a very difficult thing to do. It's damn near impossible. But understanding and predicting a change in volatility is something that you can notice if you know where to look. Doug will actually give you that particular tool and let you know step by step, walk you through exactly how to identify that high probability trade using volatility. And lastly, on day four, it's fear, uncertainty, and doubt for profit. Using fear and doubt, they are big catalysts, and they can bring huge profits through options trading. Doug will teach you how to take advantage of momentous shifts in public fear and uncertainty, like much of what you saw during Brexit, as well as the most recent presidential election in 2016. So I just wanted to bring to your attention a quick recap here. As you can see, 4 days of live training with Doug. It's done from the comfort of your own home, virtually, online. You can get all 4 days for a very limited time up until tomorrow at 5 p.m. for $9.95. But folks, we want to increase the value of this particular deal. So what we're doing is we're including lots of special offers. These particular bonuses will include a VIP pass, price protection for Doug's option strategist alert service for $9.95 for all of 2017. Now let me just explain that quickly. What's happening with the options program, it's going to be revamped, it's going to be retooled, and it's going to come out with a brand new look and a brand new feel. The pricing is set to increase sometime down the road. So when you purchase this package for $9.95 tonight or tomorrow before 5 p.m., you will lock in the $9.95 pricing, which as it currently stands now. You'll lock it in for the entire calendar year of 2017. And not only that, you'll also receive 10% off of small group coaching with Doug. Now, that's one of the advanced courses that Doug does do. It is, I'd say, eight or less people. It's very small, very intimate. It's private coaching. It's for a lot longer period of time than 4 days. Also included in the package is a free month to the option strategist. So you get to try us out before you take on that 1 year special offer for $9.95. But again, you have to purchase before tomorrow at 5 p.m. In that 1 month of the option strategist, you'll receive 2 or 3 or maybe even more actionable trades from Doug himself. He'll let you know where the exit, entry, and stop loss would be. He'll also alert you throughout the week and keep you updated to what's happening in the portfolio. Every week, as Doug did mention earlier today in the conversation that we just had during the presentation, there are 4 follow-up live and interactive portfolio review sessions with Doug. So every Wednesday, Doug gets with all of the option strategist subscribers, and they go over the current portfolio, the current state of the market, and what may happen going forward. So I just want to recap. Each day of the program is also recorded and distributed to you to keep for life. So all 4 of these days, let's say you're not available for one, you can't stay for the full 2.5 hours, you don't have to worry about that. We have you covered. We will send you the recording. So just to recap, you have all 4 of those days starting on the 23rd. You get every single bonus included for just $9.95. Now, earlier in the conversation before we started, and also Doug did reiterate, there are 2 parts to this program. So if you're not necessarily all that advanced or not ready to take on this particular kind of education, we do also have a foundation package. That foundation package currently stands at $4.95. We did do a presentation for it this past Tuesday. If you'd like the recording, you can always email in. We could send that out to you. There was a special deal, but the deadline has since passed. So I do encourage you that if you are interested in this in any way, to meet us up before the deadline of 5 p.m. tomorrow. But just to go over, we have the foundation course, which will teach you all of the specific things that you need to know prior to entering the implementation and tactics course. And if you buy the 2 combined, again, before 5 p.m. tomorrow, you can save money and you can get each, the 2 of them combined for $1,100 and still get all of the bonuses that are included. But again, we have a hard deadline of 5 p.m. Tomorrow afternoon. And just to reiterate, if you bought both, you'd start on January 17th. So it would be Tuesday, Wednesday, Thursday, the day after Martin Luther King Day. And then you'd continue into the next week, the 23rd, 24th, 25th, and 26th. And you can get all of that again for $1,100. So I just wanted to also let you know that the way that you can order this is you can use the URL link that we have here. You can also take a screenshot of that little code that we embedded there. You'll land on a landing page that looks like what's on the right here. You have a choice between just taking the foundation course, just taking the advanced tactics, or getting both. Of course, getting both is the best value at $1,100. You'd be saving yourself, an obvious large amount of money at $485 there. So, I mean, that's basically what you get here. If you have any particular interest in this, if you have any particular troubles in trading in general, and you want to learn from a professional, somebody who's seasoned, somebody that's been here for well over 18 years, that has a wealth of knowledge and experience, you can't teach that kind of thing. You can't teach experience, but experience can teach the inexperience. So I would encourage you, I would urge you to email in info@t3live.com. I'll post that in the chat section as well. You can use the URL that's located there in the slide. You can take a screenshot, and of course you'll be landing on that landing page that there is there to the right. I do see a couple questions coming in. Let's see. I need to understand the concept better before I can buy this package. Can I have today's recording? Yes, today's recording, we are shooting to render it immediately after this presentation is concluded, and we will try and send it out tonight. So be on the lookout for that email, I would say in the next 2 hours, maybe 3. If you don't see it tonight, it will be first thing in the morning tomorrow. Let's see here. There's another question asking if this could be good for seasoned traders. So as Doug mentioned, yes, it could be good for anybody that's new, that's a beginner, for somebody that's seasoned and wants to learn more about an alternative approach to options as opposed to the traditional way of trading them. This is definitely something that you could put in your repertoire for trading. I would highly encourage it. Doug is one of the best mentors that we have here. He's very personable, and he's very knowledgeable, as you can tell in the presentation that that he gave folks tonight.
Hey, Sammy, do you mind if I jump in on that one real quick?
That'd be great. Yes.
Okay. Yeah, okay. I get that question quite a bit. I've been trading options for a while, and what of these courses make sense for me? Now, this is a relatively new course, referring to other courses I've done like this. This is the way I see this. What I find a lot is that even people who've been trading for a long time, a lot of them didn't get into it with a deep understanding of the fundamentals, how the different things work. And there's a lot of things you can learn from that portion of the course. A lot of just conceptual ideas, a lot of really useful, practical things to learn about trading that you might not have thought about before. So if you are a person who's been in the options market for a while, I'd still encourage you to take the fundamentals course. If you feel like you're beyond that, that's fine. We're not going to force anybody to do anything. But the tactics course is going to give you a broad exposure to a wide variety of options tactics. And I'll promise you this, if you thought you knew one type of a trade, there's probably a lot more to it that you can learn. Now, I still learn. There's always new things to learn. So there's a lot of new things that you can still get into it. And we do not stop at the surface. We dive pretty deep. So I think that for somebody with a reasonable background in options, you could still get a lot out of that. All right, I'll hand it back to you. Sorry, Sammy, I didn't mean to jump in.
No, no worries at all. I would encourage folks, if you had any particular questions for Doug, now would be an opportunistic time to shoot them in. Doug, I'm not sure if you, if you wanted to add anything, but one thing I would like to add personally is just in knowing Doug personally and professionally, he's somebody that thrives and loves trading markets. This is something that is one of his passions. So he's not something that he has to do either. Doug has had a very brilliant career. He's done very well for himself, but he loves to do it so much that he likes to share his knowledge with people that also have passion for it as well. So I encourage you to try him out. You get lots of great bonuses that are included in this particular deal as well, and of course the whole saving money part is nice as well.
And I just want to toss in something. Knowing Sammy for a long time, it gives me the ability to remember certain nights in New York and blackmail him to saying things like that. So thank you very much.
Not a problem. Folks, this also, just so you're aware, this is a brand new course. This has not been taught before here at T3 Live. This will be probably the lowest price that we'll be able to offer this at, just because this is brand new. This is our introductory price. If any of you have attended Tuesday evening's webinar with Doug, our introductory price for the foundation course was $295. It's already up to $495 because of the demand for it. So again, if you have any interest in this whatsoever, this is brand new. The pricing is set to increase along with the option strategy. So you got a lot of options with this purchase. And the way to do it is you can go ahead and click on the URL that's in the chat box there that Amber had posted earlier, or you can email in, or you can give us a call at that 888 number down there below on the bottom right here.
Just let me toss something in on that. I just want to make a point. I've done a lot of training and teaching in the past, and what I've found is every time I teach people, I learn something about what they need, and I learn something about how to present the information, and even more pieces that are valuable to people. It's a real big advantage having this a brand new program. We got to start fresh, and I took the best pieces that I've done in the past, and I've actually added a lot of new things to this. I'm actually really excited to have the opportunity to do this. It's going to be fun. A fresh program, fresh ideas, a lot of content. So looking forward to seeing some of you there. I'd really like to see some of you join up and join us and do the program. So that's it.
I have one question here. It says, I already bought the foundation course for $295. Can I get a credit for it if I buy the 1100 combo? Well, yes, you wouldn't necessarily need the credit. We would only charge you the difference. Of course, you can call in to either one of your reps, myself or Amber. You can call into the 888 phone number. You can email into info@t3live.com. I'll also post that email address there in the chat box. So, yeah, of course, even if you purchase the first one, you'd still get the same deal here and all the free benefits that are included. Well, I think that as far as the questions go, Doug, I don't see anything new. Did you have anything that you wanted to add prior to us ending the session?
I don't have anything in particular. Happy to answer any questions you've got. If anyone's got any particulars about this, you know what? Actually, I'm going to flip this around for a quick second, and I'd like to get some feedback. I always, I like to listen to people. Well, people blame me for talking a lot, but I like to listen to people too. The stuff we talked about tonight, and I know that we had a limited amount of time. I only had a short window to show it off, so it was a little tough. But did you see some opportunities there to make some money? Did you see a chance to do something different, improve your trading, and find a way to make more profits? Because bluntly, I always have a goal of every time I talk to people is make sure that I don't waste their time. So I need to make sure that you're getting something that's valuable about that. I'm hoping that's what you saw, but pop it up there if you felt like that was valuable. That's good. If you did feel like that's valuable, there's a lot more to what we've got in this program. That was really just scratching the surface, and as much as that might have seemed a quick run through of things, it's a very understandable topic once you get going. And once you see it, it's like it opens your eyes. There's a whole window or a whole world of different trades that you can do. And that's what I want to see people get. So, Rob, just have to find the money to be able to do these things. Well, we all started out that way. I was not born with a big portfolio. It's as a matter of fact, I grew up in Maine. I grew up in a town of 3,000 people in backwoods Maine. My father was a teacher. My mom was a homemaker. I did not come from a bunch of money. This is why we do this, because we want to have that opportunity to actually control our lives and do something that makes us able to make money. I'm not going to promise you to get rich overnight. That's a BS promise. But I will tell you this: you can build up your skills and get better and better, and grow that portfolio and make money. And as you do that, you basically are more powerful in your own finances, get the results you want, and you get to where you want to go. And I think that's important. It's fun for me to do that. I've got people for years that I've been working with, and it's great. I always get everybody gets to this point where it's kind of like a kid. They go away. It's because they don't need me anymore. They're there, and they're doing it on their own, and they're flying. It's fun to see that. But the trick is you got to start and you got to do it. The one thing that always frustrates me is seeing all the people out there come to these sessions, and they ask questions, and I can see that they're smart, they've got good ideas, they got good thoughts, and then they don't do it. And then I see them at the next session, and they don't do it. And those are the people I still see 4 years later not doing it, wondering if they should have done it. Don't do that. Take the opportunity, learn, work at it, put the effort in, and get some good results. So, Rob, I noticed that you signed up, so I'm absolutely looking forward to seeing you. I'm definitely looking forward to seeing you next week. So there we go. Rob, I always get embarrassed. I don't feel like I'm that special. The fact is that this is something that should be out there and people should be learning. So I feel pretty happy to be able to hand it out. That's basically it. Let me see. Are there any write-ups provided? We do a fair number of things. Actually, beyond write-ups, I'm not sure how to say your name. Babaji? I'm trying. I don't know. A lot of the stuff that I do in the sessions, I actually make tools for. I build out spreadsheets and things like that to simplify trading. And a lot of what we do, instead of necessarily a write-up, is to actually have a tool around it that simplifies what you're doing and allows you to quickly analyze what's going on. We do a lot of that stuff. I have a lot of those that I share with everybody. But that's for the people in the classes. That's the members. So if you want access to those, I really encourage you to become a member. Jump into the education program. Just click the button and sign up. It's not that hard. But yeah, I tend to do that a lot more than a write-up, because I feel like it's more useful. Something you can actually twiddle the buttons and play with and see what the results are, as opposed to reading a paragraph that says you should see this. So that's the way I approach those. Any other questions? Any other thoughts? Any other anything? I've got a couple more minutes. Yeah, no, Babaji, that's I like having some good things to work with. It's fun for me too. And by the way, this isn't one-sided. I actually get a lot out of my groups because they have different ideas and different thoughts, and it's helped me develop all these tools and different ideas over the years. I wouldn't be the trader I am right now if I didn't spend so much time teaching people. It forces you to really think about things and understand things from a very different level. And it forces you to, basically deal with problems and questions that sometimes you don't know the answer for. So it's been great for me. And the great thing is that every time that happens to me, forces me to get smarter and understand things better, and I bring that back to you. And turns into a good cycle. Everybody gets more out of it over the long run. What's the platform I use? I use Thinkorswim primarily. I have used Interactive Brokers. I've used TradeStation. I actually have some friends who work at TradeStation, did some kind of informal consulting on their options trading platform. But primarily I use Thinkorswim. By the way, what we do has nothing to do with the platform. Everything is very, universal. The ideas are what matter. Portfolio is still possible with around 25K? Absolutely. Oh, absolutely. I've got a lot of people with far less than what you're talking about. Every time we do a trade, we also look at how it fits into your portfolio. And that gets down to how do you calculate the size that's appropriate for whatever your portfolio is. Now, I base everything in the classes and the newsletters and the weekly sessions and the trading that we do together. I base all of that off of the $100,000 portfolio. But honestly, that's because that's a neat round number and we can work from it. But I show you a really simple formula for sizing every trade to the appropriate risk level in your account. It's a couple of steps. Just look at the certain amount of risk, what it is per symbol or per position. Look at the size of your portfolio, figure out a sizing for the risk in your portfolio, a couple of calculations, and boom, you've got the number of contracts that you should do. So everything we do scales up or scales down for just about any account. Now, if you came in here and said you have $500 in the options account, I'd be happy to teach, but I'd say it's a little difficult. The number you've got right there, no problem at all. Not at all. What else do we have? By the way, I hope is everybody seeing the link over in the chat box? The www.t3live.com options/options1. Just want to double check that everybody's seeing that in the chat box and everybody can click on that without any trouble. Excellent, good. Good. Because the last thing I want to have is somebody who wants to sign up and they can't find it. That would be embarrassing. What are the questions? All right. Is everybody good here? Sammy, did you have anything you want to pitch in at the very end?
I just want to say thank you, Doug. Appreciate all your hard work. It's always a pleasure working with you, though. We've been doing this for a long time.
And I am looking to say thank you for the next time I get up to New York and you buy me a bunch of beers. Just
You got
quite
it.
as many as the last time we did that.
You got it. Let's do it.
I ran with a hangover for days after that. But yeah, no, it's always fun. I enjoy doing this stuff. This is a good time. I guess, Sammy, if you are done, we can wrap up.
Yes, sir. Well, folks, ladies and gentlemen, I appreciate again your attendance this evening. If you are interested, you have the URL in the chat box. It's www.t3live.com/options1. Just to reiterate, the foundation course is $495. The implementation and tactics course is $995. That's each separately if you buy them on their own. However, if you want to buy both by tomorrow, 5 p.m., it's $1,100. And again, this is subject to increase. So lock it in. And folks will be standing by to answer any phone calls or emails that you might have. Thank you, Doug, and I wish you all a very pleasant evening.
Hey, Baba G, I'm looking forward to seeing you there. Good to have you on board. Thanks. Everybody else, you guys have been a great crowd. I like to see the questions. I like to see the thoughts going back and forth. So thank you for that. It makes my job a lot more fun. And I am absolutely looking forward to seeing some of you in the class next week. So thank you and good night.